In the world of investing, there are numerous avenues to explore when aiming to capitalize on a company's potential. However, the classic, time-tested method to benefit from a company's growth and success is to directly buy its shares outright on the open market. This traditional approach involves purchasing a portion of ownership in the company, aligning your financial interests with its performance. But this time-honored strategy often means tying up a significant amount of capital in a single stock, potentially limiting your ability to diversify your portfolio and explore other investment opportunities. It requires a substantial financial commitment up front. What if you could achieve a similar level of control over the same number of shares, mirroring the potential gains and losses, without the hefty initial investment? What if you could participate in the stock's movements with much less money at risk, freeing up your capital for other ventures or to cushion against potential downturns? That's the core idea and driving force behind the stock replacement strategy, a sophisticated yet accessible approach to investing. It's about achieving similar results with a different set of tools. Instead of directly buying 100 shares of a particular company, which can require a considerable outlay of funds, you buy a single in-the-money call option contract, a strategic move that offers a comparable exposure to the stock's price fluctuations. This call option contract essentially represents those 100 shares, giving you the right but not the obligation to purchase them at a specific price before the contract expires. Because it's an in-the-money option, meaning the strike price is below the current market price, this option closely tracks the stock's price, mirroring its movements with a high degree of correlation. This close correlation gives you similar upside potential if the stock rises, allowing you to participate in the company's growth without the full capital commitment. You benefit from the stock's appreciation. The main appeal of this strategy? What makes it so attractive to investors seeking a different approach? Leverage and risk management are the key components. You control more with less capital, amplifying your potential gains while freeing up funds for other opportunities. And perhaps most importantly, your maximum loss is limited to the option's initial cost, providing a defined downside and protecting you from potentially catastrophic losses. This approach frees up a significant portion of your capital, allowing you to pursue other investments, diversify your portfolio, or simply hold on to cash for future opportunities. By using a lower-cost derivative like an in-the-money call option, you gain exposure to the stock's potential upside at a fraction of the cost of owning the shares outright. You maintain market exposure to the underlying asset while significantly reducing your committed capital, making your investment strategy more capital efficient. It's a smart, efficient, and potentially more flexible way to pursue growth in your portfolio while carefully managing and mitigating risk. The stock replacement strategy is a sophisticated technique employed by investors looking to replicate the returns of owning a stock, but with a significantly reduced capital outlay. It's executed in two main steps, each designed to optimize capital efficiency and manage risk effectively. This approach allows you to participate in the potential upside of a stock while limiting your financial exposure. First, the cornerstone of this strategy involves selecting a deep in-the-money call option. This is a crucial decision that sets the stage for the entire process. This means choosing an option, one with a strike price well below the current stock price. The further in the money the option is, the closer its price movements will mirror those of the underlying stock. This strategic selection ensures the option's price moves almost dollar for dollar with the stock, thanks to a high delta, which is a measure of an option's price sensitivity to changes in the underlying asset's price. A delta close to 1 indicates a near-perfect correlation. For example, if a stock trades at $100, we need to find options that are significantly lower than the current price. A $70 or $80 strike call is considered deep in the money. These options behave more like the stock itself, offering similar price appreciation potential. Next, after selecting the strike price, you must choose a long-term expiration, giving the trade ample time to mature. This often involves selecting a LEAPS option, which stands for Long-Term Equity Anticipation Securities. This extended time frame gives your investment thesis time to play out, allowing for market fluctuations and potential growth without the pressure of a near-term expiration date. This also reduces the impact of time decay, also known as theta, which erodes the value of options as they approach their expiration date. Once you buy this option, your total risk is limited to the premium paid, offering a defined and manageable downside. This premium is substantially less than buying 100 shares outright, making the strategy particularly appealing for investors with limited capital. For instance, controlling 100 shares at $100 each costs $10,000, representing a significant capital commitment. However, a comparable Leaps call, providing similar exposure, might cost just $3,000, freeing up $7,000 for other investment opportunities. This means you get similar upside exposure to the stock's potential gains. All this with a fraction of the capital, allowing you to diversify your portfolio or pursue other investment strategies simultaneously. The strategy is all about maximizing efficiency, making every dollar work harder for you. Ultimately, it's about minimizing risk, ensuring that your potential losses are capped and predictable. It's a practical way to gain stock-like exposure, participating in the market's upside without the heavy financial burden of direct stock ownership. It allows you to do so without the full financial commitment, offering a more flexible and capital-efficient approach to investing. The stock replacement strategy stands out for its capital efficiency. You control the same number of shares for far less money, freeing up capital for other uses. Your maximum loss is limited to the option premium, unlike stock ownership where you risk the entire investment. The upside is nearly identical to owning the stock, since deep in the money calls move closely with the underlying price. However, you don't receive dividends or voting rights, important trade-offs to consider. Dividends are factored into the option's price, but you won't get them as cash. This strategy is best for investors focused on growth, not income. It's a way to pursue bullish opportunities with less risk and more flexibility. Just remember, you're not a shareholder, so some benefits of ownership are lost. Let's dive into the practical application of stock replacement. We're going to walk through a detailed example to illustrate how this strategy can work in the real world. This will help you understand the mechanics and potential benefits with a real-world example. We'll use a hypothetical scenario involving a specific stock and an investor's decision-making process. Sarah is bullish on XYZ Corp, believing in its long-term growth potential and anticipating a price increase, trading at $150 per share. She sees this as an attractive entry point, but wants to maximize her potential gains while managing her risk effectively. Buying 100 shares outright would cost her $15,000. This represents a significant capital outlay, tying up a substantial portion of her investment funds. Instead, she buys a 2-year Leaps call, a long-term equity anticipation security, with a $110 strike for $4,500. This gives her the right, but not the obligation, to buy 100 shares of XYZ Corp at $110 anytime within the next 2 years. If the stock rises to $180, a scenario Sarah anticipates, her call's value increases by about $27 per share, thanks to a 0.90 delta, reflecting the sensitivity of the option price to changes in the underlying stock price, making her contract worth $7,200. This represents the intrinsic value of the option, which is the difference between the stock price and the strike price, multiplied by the number of shares. Her profit, $2,700, calculated as the final value of the contract minus the initial investment. A 60% return on her $4,500 investment. This demonstrates the power of leverage in options trading. If she'd bought the stock directly, her profit would be $3,000, a 20% return. A respectable gain, but significantly lower than the return achieved with the options strategy. The option delivers similar dollar gains, but a much higher percentage return due to lower capital at risk. This is the essence of the stock replacement strategy, amplifying returns with less capital. Plus, her maximum loss is capped at $4,500, not $15,000. This provides a defined risk profile, limiting potential losses to the premium paid for the option. The rest of her capital can be used elsewhere, in other investment opportunities or to manage other financial needs, boosting her overall portfolio efficiency and allowing for greater diversification. This efficient use of capital is a key advantage of option strategies. This example highlights the power and safety of the stock replacement strategy, showcasing its potential to enhance returns while mitigating risk. The main draw of stock replacement is capital efficiency. By using options, you can mimic stock performance while committing 50–75% less capital. This lets you diversify across more stocks or asset classes, reducing risk. The saved capital can also earn interest, offsetting the option's time decay. Even if your dollar profit is slightly lower, your return on invested capital is often much higher. This is leverage used wisely, achieving more with less. It's a powerful way to maximize your portfolio's potential. Another key advantage is defined risk. With stocks, your entire investment is at risk if the company fails. With a call option, your maximum loss is the premium paid, no more. This built-in safety net allows you to size positions more confidently, even in volatile stocks. There's no need for stop-loss orders. The risk is capped from the start. This clarity helps you stay focused on your long-term thesis, not short-term market swings. Defined risk transforms uncertainty into a manageable cost. It's a disciplined, patient approach to investing. The stock replacement strategy isn't perfect. Time decay, theta, erodes the option's value daily, even if the stock doesn't move. If the stock trades sideways, you can lose money just from this decay. You also forfeit dividends and voting rights, important for income-focused investors. The strategy requires a solid grasp of options. Picking the wrong strike or expiration can hurt performance. Deep in the money calls still lag the stock slightly due to delta being less than 1. In flat or mildly bullish markets, direct stock ownership may outperform. The strategy shines in strong uptrends, but it's not for every situation. Know the trade-offs before you commit. Stock replacement works best when you have strong long-term conviction in a stock's growth. It's ideal for high-priced stocks where buying 100 shares is costly. The strategy makes these investments accessible with less capital. It's also great for those seeking leverage without the risks of margin debt. Use it for growth stocks with low or no dividends, since you'll miss out on income. Avoid it for high-yield stocks where dividends are a big part of returns. The best candidates are companies reinvesting profits for growth. This approach lets you amplify returns while keeping risk in check. Deploy it thoughtfully, focusing on quality, long-term opportunities. In summary, stock replacement is a smart alternative for bullish investors. By using long-dated, deep-in-the-money calls, you get stock-like upside with less capital and defined risk. The benefits: capital efficiency, diversification, and peace of mind from knowing your maximum loss. But it requires understanding options and accepting the loss of dividends and voting rights. It's not a one-size-fits-all solution, but a specialized tool for specific situations. Use it when you have strong conviction in a growth stock and want to optimize your capital. Done right, it empowers you to be more strategic and risk-aware. For those willing to learn, stock replacement is a valuable addition to any investor's toolkit.